When looking for stocks that pay dividends, utility companies are definitely ones you should include in your portfolio. Not only do they usually have a long history of paying and increasing their dividends, there's usually not a lot of competition because of the massive infrastructure required to get into the game. And on top of that, the last time I checked, people usually need utilities, they need heating, they need electricity, so I don't see them going out of business anytime in the future. But as the interest rate rises, we might see a pullback on the utilities, and that may prove to be a good buying opportunity. Stay tuned as we take a look at some of the best utility companies in Canada and determine which one is a good buy. First, as a disclaimer, I just want to say I'm not a financial advisor, so please do your own due diligence before investing. There are a couple of popular utility companies that I left out, such as Brookfield Infrastructure Partners and Northland Power, because of their massive payout ratios. When you take a look at the cash flow, they're still able to maintain their dividend payout no problem, but when you start factoring in other factors such as depreciation, they are at a loss. When looking at the market cap, Fortis is the largest, ATCO is the smallest. ATCO is a holding company that has a 52.3% stake in Canadian utilities, and it owns many other utility companies outside of Canada as well. But when we take a look at the chart, in my eye, we clearly can see two winners, Fortis and ATCO. They both have a long history of paying the dividends and raising them every year. But overall, they have all done very well in the past, but the recent couple of years, some of them have not done so well. We can see this very clearly when we take a look at the annualized return of each utility company, and I see a lot of red. This is kind of expected as the interest rate rises. On the short term, we usually see a pullback on dividend paying stocks, and utility companies are known to be good dividend paying stocks. When we take a look at the chart, we can see the general pattern. In the past 3 years, they all haven't been performing very well, and as stock prices drops, the percentage yield goes up, and it will reach a point where the yield will become very attractive again. When taking a look at the revenue, we can see some really big spikes up in the companies such as Fortis, Emera, and Algonquin Power, but that's due to acquisitions, so we have to take that growth with a grain of salt. But overall, we see the trend upwards as the company grows. We can see this uptrend more clearly when we chart out their profits, but we do notice a spike downwards in a few utility companies, more notably in Canadian Utilities and ATCO, but their revenue is still on the uptrend, so hopefully this is just a minor hiccup. The EPS chart is just all over the place, spiking up and down, hard to see much useful information from it. And when we take a look at their PE ratio, most of them are trading around 20 times their 2017 earnings, except for Algonquin Power trading at closer to 30, and Emera trading at around 35. Hydro One is the lowest and looks interesting, but it went public not too long ago, so we don't have too much historical data on it. Now onto the dividends, we can see them pretty much all trending up, with the odd hiccup on a few of them, more notably on Hydro One, but I would take that data point with a grain of salt as it just went public that year in November. But overall, they've all been able to grow the dividends over the decades very nicely. So if you bought early on, you'll be receiving some amazing yields based on your purchase price, but there are probably some people out there with yields at around 20%. Overall, their dividend growth has been very steady and consistent, and we can see this very clearly from the chart. But some of them are really pushing it based on their payout ratio, and I'm not sure how much further they can really grow the dividends before it starts getting dangerous and they cannot afford it. So let's take a look at their payout ratio. The first thing you'll notice is that some of their payout ratios are way too high, and it gets me questioning if they're able to continue growing and paying their dividends. Emera, Algonquin Power, and Canadian Utilities all have a payout ratio above 100%. With payout rates that high, I would stay away from them because we are unsure if they're able to continue to pay and further increase their dividends in the future. When we look at their price to book and price to sales ratio, they're all roughly around a similar level, with Algonquin Power being the small outlier on the expensive side. When it comes to debt, they all have a pretty sizable debt based on the market cap, but that's understandable for utility companies because of the large infrastructure required to get started. So yes, that's not a good thing, but it can't be helped. But pretty much every utility companies you look at will have a pretty sizable debt based on their size. So now we'll come down to the question, which one do I consider a worthy buy? Right off the bat, I would eliminate Emera and Algonquin Power because of the massive payout ratio. Yes, they're still able to pay their current dividend with their current cash flow, but I want to be looking at the bigger picture, and depreciation is definitely a factor I would factor in, because eventually they will have to invest and repair the infrastructure sometime in the future. When it comes to ATCO and Canadian Utilities, I would prefer ATCO because it's more diversified. Not only does it own 52.3% of Canadian utilities, it also owns other companies outside of Canada, such as in Australia, the US, Mexico, and South America. Fortis, on the other hand, has been a great stock to own and still continues to look great, and would definitely consider it on any dips. and Hydro One is still fairly new. It started off as a crown corporation which was solely owned by the Ontario government, but in 2015 the government started selling shares with the final goal of selling about 60% off to raise money for other projects. There's been a lot of uncertainty with Hydro One because the Ontario Premier Doug Ford has been targeting the current board and the CEO to get them removed and replaced, and they have been, so we'll have to see where they go from here. And the Ontario government still owns a big chunk of the company, which still causes uncertainty for the company, but if they work it out, it can be a good buying opportunity and we'll definitely have it on my radar. And as always, if you guys enjoyed the video, please like and share the video. It really helps out the channel. If you haven't subscribed yet, please make sure to smash that subscribe button, and thank you for watching. I'll see you guys in the next video.